everybody, this is our second video lecture on financial accounting. In this lecture, you are gonna learn how to record business transactions. But before getting into the main concept of the lecture, let's see what's a transaction in accounting. A transaction is any event that has a financial impact on the business and can be measured reliably. This is the formal way of explaining transaction, and the most common way of recording transactions is the T account. On the top of each account, we always have the name of the account. And here I will introduce two main concepts in accounting, which are debit and credit. On the left hand side of the T account, we'll always have debit, and on the right hand side of the T account, we'll always have credit. And to understand what debit and credits are, let's memorize our accounting equation once again. So, how it works like? Assets are equal to liabilities plus owner's equity. And keep this in mind, this is very important. We'll have always our increase in assets, in one of our assets as debit entry, and the decrease in one of our assets as credit entry. And the vice versa is applied to the right hand side of the equation. It's like if we have a decrease in our one of liabilities, it's the credit entry, and if we have increase in one of our liabilities, it's the debit entry. And the vice versa, the same version is applied to owner's equity as well. An increase in one of owner's equity is a credit entry, and the decrease is a debit entry. So this is the explanation of credit and debit, and we'll work on this ones with some examples of transactions. I have some examples of transactions, and I'll show them to you. I want to show them to you. I'll show. So the first transaction is like, let's imagine a imaginary organization, Soft PLC, and in the transaction 1, Soft PLC issues ordinary shares worth of $1,000. And which entries do we make here? So that's fine. So transaction 1. Well, we issue shares and get money instead of that, right? We give some documents to our shareholders and get money from them. Therefore, our cash increases in our budget. So it's the debit entry in one of our assets, which is cash. Cash is the ordinary assets we have. Any organization has an ordinary asset, cash. So another term here is share capital. Share capital is earned when we issue shares, and it shows how many shares we have on the market. So we will credit share capital. Share capital is one of our equity, and so an increase in equity is credit entry. So we'll debit our cash, which is an asset, and we'll credit our share capital, which is equity, by $1,000. It is the transaction 1 and T accounts showing the transaction 1. This is the very simplest one. So let's move to the second transaction. In second transaction, Soft PLC purchases an office to work on cash for $7,000 cash, $7,000. So the transaction 2. Office is an example of assets, and we'll say office as property, plant and equipment in the future, but so far we'll notate it like office. So it is an asset, and an increase in asset is a debit entry. On the left hand side we'll have 7,000, and our cash decreases, right? We purchase an office, so we pay for that, and our cash decreases by $7,000. So we'll credit our cash. We'll write 7,000 on the right hand side of the T account called cash. So the third transaction, let's move to the third one. Soft PLC purchases office supplies worth of $300, and the payment has to be paid 3 months after. The payment, the cash so far we haven't get any cash, but we'll get that cash after 3 months. So the office supply is an example of assets again. The office, we have office supplies. This is an asset. So an increase in asset is a debit entry. We'll have on the left hand side $300. And the new term here is account payables. We recognize account payables if we get some assets, get some services, and we haven't paid for them. So this is account payable. We owe them some money, and this is account payable, and this is the example of liability. And increase in liability is a credit entry. So we have on the right hand side of T account $300 on the credit side. So this is the third transaction, and let's move to the fourth one. Soft PLC provided services to Delta PLC worth of $4,000, and the payment has to be paid next month. So we provided services already, but we haven't get the payment. So we haven't got the payment. So let's see what happens. Transaction 4, the new term here is account receivables. It is the opposite of account payable. So we provided services, or we sold goods, but we haven't get the payment. So we have account receivables. We'll get the payment in future. So it is the asset, and an increase in asset is by 4,000. It is a debit entry. We write that on the left hand side. So if we provided service and we have our asset go up and assets go up, but any other liability doesn't change. Any other liability doesn't change, and any other asset doesn't change. We just provided services and haven't got the money. We haven't got money, so our cash does not increase. So our account, only the change is in the account receivables. But this is the rule of double entries, that we must have at least one debit entry and at least one credit entry according to each transaction. So if we have a debit entry, we should have a credit entry as well. So this is the rule of accrual accounting. So we recognize this as income. So income is increase in equity. Our asset goes up, our liabilities doesn't change, or another asset doesn't change, so our equity goes up. So an increase in equity is income. So we get income so that our equity goes up. So an increase in equity is a credit entry. So we have income, and on the right hand side 4,000. This is the fourth transaction. In the fifth transaction, Alpha PLC paid 4,000 to Soft PLC in respect of the services to be provided from next month for for months. So we got this is the opposite. We got the payment, but we haven't provided the service. So our cash increases, we got the payment by 4,000, our cash increases, but we haven't provided services. So we have a liability, and this liability is called owner security. We have to provide the service. This is called unearned revenue. We haven't provided services, but we got the payment. So this is a liability, and an increase in liability is a credit entry. So we have on the right hand side unearned revenue credit entry. So that's all for today, and in the next lecture we'll continue.